All right, test, test. I've not done a live before. If you can hear me, let me see. I can't really tell. It looks like we have several of you live. Can you hear me?
Test, test.
Okay, that's me hearing myself. If you can hear me, right, I can hear you in the comments. Let me see here real quick. Can you hear me? If you can, let me know, and then we can dive in. Okay, good. It looks like you guys can hear me. I wanted to quickly introduce this video by sharing. I've been getting a lot of questions from you guys about why do I do these videos? Why do I update you guys with what I'm doing? And I've been thinking about that a lot because it made me reflect. The reason I do these videos though, first of all, I love really being of value. So we're gonna dive into your guys' questions. If there's anything you guys wanna talk about right now on this video, I'm here to talk about that. I love being of value. For those of you guys who found me through Dan Pena, in the fact that I've been following his process, you know there's two bank accounts in life. There's your financial bank account and there's the emotional bank account. I find that by answering questions, trying to be of value, by creating content like this, that really fills up my emotional bank account. And I also find that it's really difficult to do cold calls on the weekends. So there's not really that ability for me to reach out like I'm able to do Monday through Friday. So that's why I do these videos. That's why I want to keep doing things like this. I'm happy to give you guys updates regarding where we're at, currently in growing our investment group and the stage that I'm currently at right now. Let me go real quick here. Any initial questions? And I'm going to write this in the any initial questions. We'll start with that. Questions you guys want to have. I've been asked a couple of questions that I can talk about real quick. One of them was, should you try to start a business like this without some funds saved up? Should you try to start, a M&A style of business, an acquisition-based business without funds saved up? Or could you do this with a full-time job? And I would say those are difficult questions for me to answer. But generally speaking, if you have money saved away, it's going to give you a lot more leverage, because if you're basically broke when you start, I can tell you that you're not going to make money right away. The whole process of, if you're following a Dan Pena type of a philosophy where you're growing a business through acquisition, is that you're starting here and you build your board, you build your chairman, then you get your accounting firm, then you get your law firm, then you start talking to banks and lenders and financial institutions, and then you really are getting deal flow, and then you're closing a deal. Right, and that is the process. Those are the step-by-step processes, other than, of course, building the perception and really presenting yourself from the beginning like you are, of course, a success. But given that, it is difficult, I would say, to go through all of those steps if you are broke, because you got to eat. I figure you want to live indoors, right? You want to show up sharp when you show up to these meetings, and it's pretty tough to do so if you're living under a bridge. So yeah, I would recommend you have some money saved away, and or you have a job that's supporting you. Could you do this part-time? Yeah, absolutely. Would it take you longer to go through the steps if you're doing this part-time? Of course. But those are just the realities of the situation. Okay, we do have a question here. Alex asks, how do you decide if you should go 100% seller financing or do a 5% down SBA payment or loan? Okay, let's talk about that. So first of all, I would say a seller finance, if the seller is willing to finance the full deal, that's gold. That's money. It means you don't need to talk to a bank. Look, to do an SBA loan, which I'm not an expert on SBA loans, we actually are not really focused on SBA loans. That's a small business loan, if I'm not mistaken. We're not focused on SBA loans because they don't translate very well in our unique industry, though they do work for a lot of the other industries that Dan Pena recommends that a lot of you guys roll up. But seller finance is gold. Seller finance is gold for a couple of reasons. One, seller finance is gold because you don't have to negotiate with a third party. It's you and it's the seller, and he's going to finance the deal. The seller is going to finance your deal. So it's just a real simple way to play. With an SBA loan, you're going to have to fill out, tons and tons and tons of paperwork. There's a long process, if I'm not mistaken, before you get your loan accepted. And so I would say seller finance is the best way you could go. Of course, as well with seller finance, you may not have to put any money down. Whereas with the SBA loan, you were talking about, if I'm not mistaken, a 5% down. And again, I'm not an expert on SBA loans, although 5% down is a really small percentage to put down. Hey, if you're able to do that, by all means, that's 95% loan to value, or at least loan to purchase price, right? If you're putting 5% down, then you have 95% that's financed by a government SBA loan. That's a pretty good play as well. So I would say both of those work. Ultimately, it's just about getting the deal done, right? So any port in the storm, as my father used to say to me, meaning if you're out there in stormy seas and you see a port, you're going to get into that port irrespective of if it's a beautiful looking port or it's ugly. You just get your ship in that port so that you're safe, right? So in this case, it's, hey, look, any way you can get the deal financed is good enough, right? But ideally, you want the biggest amount of spread possible. Dan talks about a 150% or greater debt service coverage ratio, a DSCR of 150% or more. And what that means is after you pay off your debt service, you still have another 50% of margin where there's free cash flow. And so that's really important. So whenever you're looking at different financing options, that's one of the real keys that gives you leverage in the negotiations. If you're able to say, hey, look, there's this huge spread. We have another 60% of free cash flow after we cover our debt service, right? Then you're going to be able to have a lot of lenders that are interested in talking to you, because that's a pretty safe way for them to lend, right? It's a lot safer than if there's only a 4% coverage, which is, of course, not as safe. Let's see if there's other questions right now. Any keywords to add to your mission statement? Keywords to add to your mission statement. Your mission statement. Dominate. Keywords is tough, right? Keywords is kind of like buzzwords. What I would say about your mission statement is that it needs to just be as persuasive as humanly possible. And I went slightly different to what Dan recommended insofar as if you get the big hardcover, your first 100 million book from Dan, there's actually, and I just learned this recently, a lot of the templates are in that book, which you can buy. He talks about how he's willing to sell that if you call the castle. But he gives an example of a mission statement that I believe is truly a one-pager. We went a little longer, and we found that worked really well for the accounting firms, the law firms, and for the banks, because those are all professionals that go really in depth as far as their due diligence. And so we wanted to give them a bunch of stuff for them to read. It's pretty similar if you go through Dan's old stuff where he talks about the 1993 content where, in Dan's 1993 content, he talks about with bankers how you want to fill up their file. This was back before you could send emails and stuff. So Dan was talking back in the day of how you want to fill up their file. You want it as thick as this book, right? It's just, look how many, it's 400, 500 pages of stuff. Well, that's kind of what we did with our mission statement. We actually call it a company profile, or I think we call it the Brighter Living overview, if I'm not mistaken. So it wasn't quite a mission statement for us. We really morphed it a bit. But this is the thing, is if it makes sense, it makes sense. It's kind of, the deal's either hot or it's not. So if you're able to explain your venture through persuasive languaging and by diving into all the details, whether it's the other competitors or the margins or your strategy insofar as what you're going to look at in acquisition targets, right? We only want acquisition targets that have this, and that, and we won't consider something that has that, right? So you're really selective with what kind of acquisition targets you'll consider. Then it's, hey, when we do find an acquisition target like that, these are the 4, 5, or 6 or 7 things we're going to do afterwards immediately to increase the margins, right? We're only looking at acquisition targets in these regions or in these regions for this and that reason, right? These are the types of things you're talking about, at least what we talked about in our mission statement, but it was more of an overview that talked about our acquisition strategy and really our methodology for being successful. We found that to be very effective when talking to bankers, accountants, and lawyers. With private investors, they like a shorter deck, aka a PowerPoint, and then we gave them that long form thing for them to review more deeply after we already whetted their appetite. So hopefully that helps. Let's see. Okay, we've got a bunch of questions now. Explain why you dropped out, or actually, I'm going to keep this in order. Deal flow. What are you utilizing? Direct approach, events, social media. For deal flow, in short, mainly cold calling. I have relationships with different brokers. One of the individuals on my team is reaching out to brokers as well, but we really prefer cold calling because we don't like to be negotiating with other individuals in the negotiation table. If we make a cold call, we, in a vacuum, or at least in theory, are the only negotiator at the table. Whereas if you're talking to a broker, if you're going to social networks, you're doing some of these other ways, you're more likely to be competing for that purchase, right? I don't want to have 5 other people bidding against me. I want to be the only guy bidding. Cold calling is the way we found that to be most effective. You mentioned social media. Look, in my industry, these individuals aren't very often on social media. I'm reaching out to retirement age owners. They're usually 70, as you know. Most 70-year-olds don't have an Instagram. So we're not sliding into the DMs. We're sliding into their phone, making a call. Hey, how's it going? Blah, blah, blah. Cold call. So that's really the way we're getting deal flow. Okay. Explain why you dropped out of the Mentee program. Look, I talked about this in a prior video. I may have actually now deleted that video some of the videos I wanted to delete insofar as I don't want to in any way, shape, or form slander Dan Pena. He actually recently dropped a video that somebody messaged me where he's making a little bit of a threat to another individual who's actually in my mentee class, who I don't know what he's up to. I'm not going to comment on that. But I dropped out of the mentee program mainly because of the time arbitrage, and I didn't find it was in my favor. In short, it takes about 5 or 6 hours a week to complete the mentee program, and it's an accountability system that's really ideal if you don't have a lot of discipline or accountability in your life. For me, I have a lot of accountability and a lot of discipline that I've been working on for years and years and years now. And so I didn't need to go through a 6-hour process to keep myself accountable. I work 100 hours a week, whether I'm doing that or not. So that 6 hours a week was a lot of time for me to basically invest each and every week to keep myself accountable when I already was accountable. On top of that, what I was finding in short was I really wanted to prove myself. And also there are some differences between Dan Pena's philosophy on business versus mine. And as you know, Dan's a very strong personality. He's a very strong figure. And he, of course, is going to tell you the way you should run your business when you're in the mentee program, which by all means respect. I'm saying nothing negative about Dan. What I am saying is that I have a different philosophy about business. I subscribe to a little bit more of a Gary Vaynerchuk philosophy than perhaps a full-on Dan Pena philosophy, which some of you guys who have interacted with me a bit more maybe can see. And so for those reasons, I took everything I could from Dan, and I realized I think I got what I needed. Now I'm going to go do this thing. So that's why I dropped out of the mentee program. Hope that helps. Let's see. How much luck have you had finding down payment options such as master lease financing or some other ways to fund if you are starting at absolute zero? So I'm not an expert on a master lease option. That's something you can do in the real estate space. What I can say is if the deal's hot, the deal's hot. And if the deal's not, the deal's not. We're at a stage right now, it's just to be really transparent with you. We're still looking at deals. We've not put any parks under contract. We've not made any official offers. The reason we've not made any official offers is because I'm a huge believer in investigate before you invest. Investigate before you invest. Go back to Dan's old 1993 stuff for more details on that. Investigate before you fucking invest. It's a huge deal because look, when you sink your money into something, it's yours. The good, the bad, the ugly, you want to know what you're investing in. But what I can tell you is when you investigate very thoroughly ahead of time and you have a laundry list of contacts in different lending spaces, whether it's private equity firms or angel investors or venture capitalists or syndication style real estate investors and the whole continuum of different people who lend, you talk about then mezzanine debt or bridge debt, right? And then of course you have your traditional debt type of financing. But when you do a ton of due diligence ahead of time and you only bring the individuals in your capital network, aka your network that could potentially fund deals, you only bring them something when it's hot, when there's huge spread, minimal downside, and huge upside. We found that people, with the parameters we're looking for in deals, I've had multiple people say, hey, when you bring me that, I will, yes, I'm in. Right? So that's really the thing is we've set the bar so high for what we're looking for in an initial acquisition target that we're finding there's plenty of people who would want to get in with us or basically help us and fund us when we were able to find that. So we've kind of reverse engineered it where it's, we're going to set such a high standard for our first deal or two as far as we have to have a winner before we're going to reach out to our network of investors and look to get that funded, that as a kind of a reverse effect, these lenders and different investors have basically said, yeah, if you're able to find that, I'm keen. That would be really, really, really great. So the money in my industry has been a lot less of the issue. The great deal has been the tougher thing to find. The great deal has been the tougher thing to find. That's just in my space. That's not to say that if you do cybersecurity or healthcare or telco or whatever, that it would be different. I'm sure it would be different. I'm just speaking about my experiences. Hopefully that helps. Let's see here. Jason, my bank is the Citizen Bank. Yeah, I'm familiar with them. They charge a $2,000 fee to evaluate any deal before they provide the loan amount. How do we avoid this fee? Talk to more banks. I would talk to other banks. There's a million banks out there. And this is the thing. Dude, I should pull up a screen of all my financing options. I literally have we call it the Brighter Living Master Financial Document, the Master Financial Document. And there are hundreds and hundreds of banks, hundreds of, different investors from all the different kind of spectrum of lending, whether it's private equity or angel investors or venture capital or mezzanine or traditional lenders, community banks, all the way to your bigger banks, your regional banks. We are connected with so many different lenders that if one lender tries to give us, we need this or that, then I just call the next lender. Okay, great. I guess this isn't going to work then. Next. The one thing you always have in negotiation or your ability to be persuasive is your ability to walk away, your ability to say no. And I'm going to get fired up here real quick because this is a big fucking deal that I see a lot of people struggle with, and I've struggled with this myself. So I'm not pointing the finger at you. I'm saying I've struggled in my past to be able to say no to things. No, we do not agree. We're not paying you $2,000 to look at a deal. No, we'll talk to the next bank. And do you know what? Your ability to say no and to walk away and mean it. It can't be a fake walk away. This isn't a tactic. This is a philosophy. This is ethic. This is deep. This is you. When you have that ability deep down to walk away because you're from a place of abundance, right? You're talking to tons of bankers, tons of lenders, tons of investors, all of this. You're able to say no, and that keeps you from getting jerked around. And funny enough, it's the same with dating as it is with business. And I used to be very focused on dating, for those of you guys who have known my stuff for a while. We all want the thing that doesn't want us, right? We all chase the thing that starts getting away, right? We had a deal that was hot, and then suddenly the guy says, no, thank you. I don't want to work with you. Suddenly we want that. Oh, I want the thing that doesn't want me, right? This is why, as guys, all of us have chased a hot girl that wouldn't always reply to our texts. Let's think about this for a second. I know this is a different topic, but it's the same fucking principle. Think of Cindy. Cindy's hot. You want Cindy. You text Cindy. Cindy, how are you doing? Cindy, Cindy. You text Cindy. And I've done this too. I'm not saying it's just you, right? So I text Cindy. Cindy doesn't reply to me. So what happens? I start thinking about Cindy more. And you've seen it on the other end. Think of Beth. Maybe Beth's not quite as cute. Beth's always texting you. And you don't always reply to Beth because you're not so interested in Beth. What happens with Beth? The less you reply to Beth, the more Beth thinks about you. The more Beth texts you. Now, how does this apply to business? It's the same damn thing. When you're able to walk away from a deal, banker A, you say, no, banker A, I'm not paying $2,000 in fees just for you to go analyze the deal, okay? These are the financials. These are the things we've looked at. We'll pay you that transaction price after the deal closes, but we're not paying you $2,000 up front just to go look at it. So if that's what you need, we'll talk to the next banker. And he says, well, that's what we need. And you say, well, have a nice life. And you leave. And you go talk to banker B and banker C and banker D and banker E. There's a good chance banker A is going to be like, damn, that deal must have been pretty darn hot, because he would only act that way if the deal was truly hot. At least that's what the banker's going to be thinking, right? So this is human psychology. You have to be willing to walk away. It's not a bluff. It's a principle. And that's the difference. It's not tactic. It's ethos. It's your ethic. It's your philosophy. I hope that makes sense. All right, let's keep going through a few more of these. I am going to have to roll in about 15 minutes. So if you got questions, I'm going to try to go faster and ramp through these. Okay. He also said, okay, I already explained why I dropped out of the Mentee program. So listen, I already did that. Please explain. Okay, excuse me. He said if you could torrent it for free, so he's cool with people downloading it. You're talking about Dan's book. I'm not a guy that knows how to torrent, but go torrent. Go get him. I'm on board. Yeah, this guy's saying you probably need to go to another bank then. That's exactly right. You talk to a bunch of bankers. That's the best thing you can do, is talk to a bunch of bankers. Okay, next question from Scott. What if there is trouble with board members? Can they leave with a percent of business? And do you think storage is fragmented enough? I'm looking at self-storage. Okay, yeah, I remember you, Scott, about self-storage. The mobile home park industry is more fragmented than the self-storage industry. That's the reality of the situation. The thing with self-storage is it's easier to build new self-storage. So the supply is continuing to increase, whereas self-storage has a capped supply. And at first, the capped supply makes mobile home parks really interesting, but it also means it's tougher to find great deals in the mobile home park space because there's only so many of them. There's 44,000 mobile home parks in the world, or in the United States. I'm not sure how many self-storage units or facilities there are. As you know, Extra Space as well as public storage. Those are two behemoths that have done extremely well. I would study up on the public storage hub and spoke model, where they basically have one facility office and then a bunch of facilities within a 200-mile radius of public storage. I like the self-storage space. I actually went to the castle expecting to take action on the self-storage space. I decided to do the mobile home park space. I think both industries have their pluses and their minuses. I think it's favorable. I think you could have success with it. And then I'll answer your other question. What happens if there's trouble with the board? Can they leave with a percentage of your business? Well, that's a two-part answer, because once you formed a company, yeah, you sign some legal documentation. There's specific words for it. I have it in my notes. I forget it right now, but it's basically a double binding contract where, hey, if you leave at this stage, you can take away, your percentage of the business, but you're only going to be able to get this much, right? So there's a contract that you write when you form your company, when you close your first deal. And yeah, it gives the board members some level of leverage so they can get their stake, right? Because that whole giving away equity thing, that's not lip service. That's not lipstick on a pig. That's real. That said, before you form your entity, the board has no leverage whatsoever, right? So in this stage right now, if you look up Brighter Living online, you will not find it. We're actually finally about to form here right now. But if you look up Brighter Living online, if you go into those those web pages where you're able to look up formal corporations, you will not find Brighter Living. We have not formed. We have not legally formed. And so what that means at the minute is if the board wanted to leave right now, they have no leverage over me. I'm sure this is why Dan recommends you don't form the company until you're about to close your first deal, because it honestly, as the CEO and founder, gives you a ton of leverage. It gives you a ton of leverage. You're this entity that is able to operate like a business without the restrictions or the restraints that a informally formed company have to operate through. So it doesn't mean you break the law. It simply means, however, that there aren't contracts underwriting everything that you do in your business. So it's an interesting place to play in. But yeah, once you form, then of course they have leverage over you. And if they want to leave, they're going to be able to take a piece. What that looks like exactly, I don't know. I'll know more in the future. But I wouldn't worry about it. Get yourself in that position where you have that problem to worry about, right? That's success in a nutshell. Giving yourself bigger problems to worry about. All right, let's see. A couple more questions, then we're going to roll. To put this in perspective, I'm in KC. I assume that maybe means Kansas City. There are over 730 business branches in the metro area. That's on city. On a national bank scale, there is no reason to bend to. Yeah, this guy's saying the same thing. K-Fane, whatever your name is, and by all means, thanks for being here. That's exactly right. You want to talk to a bunch of banks. That's the name of the game. Don't let one bank jerk you around. Thanks for making the channel. I really look forward to it. You got it, man. A couple more questions here. How can we learn about the industry that we are looking to get into? What is the best source of info? Latif, I kind of want to kill you right now because, dude, it's called fucking Google. It's the internet. Come on, man. If I have to tell you how to research your industry, then you won't be successful. I want that to sink in. And this goes for all of you. And I love you guys. I want you guys to be successful. Okay, but I'm not gonna pretend that this is easy. I'm not gonna pretend that I can just answer all these questions for you all the way through and through, and that's gonna make you successful. If you can't figure out how to look up and research your own industry, then you're probably not ready. I'm sorry, man. I gotta be a dick sometimes. That's the truth. All right, let's continue. I have a commercial cleaning company, 4 million in revenue, fair play. I'm starting to look for smaller ones to acquire. What does Dan think about this type of an industry? He tends to like those kind of niche service-based industries. He tends to like those. Now, that's a hugely generalized statement. Take with it what you will. But often, for example, I remember when I was at the castle, there was a plumber who had a real similar business to you. I think they were doing a couple million a year in revenue. It might have been in total valuation, but he had a nice little company going, like you. Like you're successful. He had some level of success. Dan would say, the 4 million revenue a year is mouse nuts, and I believe in that type of thinking because it makes you think really big, right? I've not done dick as far as real wealth yet, right? So I'll be the first to say it. But what Dan was telling the plumber was, dude, it's time for you to go gobble up other little plumbing shops. And I remember that guy, the plumber that was at the castle when I was there. I believe he was already calling on several plumbers when he was at the castle and having some level of leverage in having those discussions. When you already have pre-existing revenue in your business, dude, if you just get a board of directors, you're going to be a fucking force. So with those of you guys who already have pre-existing businesses, QLA is a fucking slam dunk because I'm starting from scratch, right? You're not. You have 4 million in revenue, per your claim there, which I believe to be true, right? Why would you bullshit on YouTube? It's not like we're going to know. So leverage that. The board is going to jump on like stink on shit, of course, and if I'm not mistaken, you're my guy from Brazil with a name like that, Rafael. You most likely are from Brazil. So get a kick-ass Brazilian board and follow the QLA steps and go into acquisition mode and just make sure that you're not, I would say, because you have some level of strength as a business with revenue, one sec, you would be able to do a lot more risky deals than I can, right? For me, I don't have the ability to do riskier deals because there's nothing for me to fall back on. There's no pre-existing revenue. I'm buying my first revenue, right? So for you, however, because you have 4 million in revenue, you can do some ballsier things, but I would suggest to you that don't try to cut corners. Don't try to cut corners. I've heard many stories kind of through the QLA, it's just kind of little things you hear from other individuals that are kind of connected to this world, where some of the individuals get into QLA, they realize it's so fucking successful and it works so well that they try to cut corners. They try to cut down on their margins. They jump on lukewarm deals as opposed to hot deals. They do different things that ultimately put them in compromised positions. And trust me, there are some businesses that follow the QLA model that don't really follow the principles through and through, like the free cash flow covering debt service by 150%. That's a huge principle in QLA, okay? Because that's giving you margin to be successful. So with a $4 million business, trust me, you'd be able to get a loan that would be way lower than 150%. Because you already have pre-existing revenues. You can do receivable. I mean, you could do receivable financing even if that money's not even gotten to you yet. There's a whole bunch of ways when you have revenue you can finance deals, especially if you get good accounting and law firms, which again, that's the QLA process. I would go through that. But I wouldn't get risky with it because you can grow a fucking behemoth by being smart. So that's the thing. It's kind of the Warren Buffett play. I'm a big believer in Warren. You know, I have a little bit more of Warren Buffett in me maybe than I'm a little bit more on the pragmatic side than Dan. I like things that make fucking sense. I'm in the buy and hold business. And I would say if you're trying to buy and hold and grow your business to be a behemoth thing, if you're pragmatic, you go through the steps and you stick to the 150% cash flow covering debt service play, you can grow a behemoth business without a ton of risk. So that's an idea for you. Hopefully it helps. A couple more questions, then we're going to roll. I'm in the internet business. I don't really know much about the internet business. Since most people are younger and not retirement age, I think it's tough as fuck to consolidate the internet business. The next guy down, our guy here, UC, I talked to him recently. The internet business is tough to consolidate. Most of you, the CEOs in the internet business, they're wearing, you know, their underwear when they do code or they do Facebook ads and things like that. So I wouldn't try to consolidate that space, but fuck, what do I know? I'm not saying that's right. I'm just saying for me, I would not have any advice for you on how to consolidate that space. Yep, and it looks like, let's see, if there's any other questions, hit me right now because I'm about to wrap. We got a couple of you guys talking back and forth. We got one more guy here. What's your schedule in terms of making your first acquisition? Also, what problems do you anticipate when merging and rolling up several companies? My schedule is as soon as we find a hot fucking deal, we're going to jump its bones. And we have one that is hot, but the seller is at retirement age but not needing to sell. So it's more of a relationship play. So we're currently nurturing him. It's about a $4 to $5 million deal. It would be a great first deal. It's a perfect acquisition target. But the only thing is that the guy isn't a true motivated seller. He doesn't need the money and he doesn't have pancreatic cancer. So what that means, however, is yes, he wants to sell because he's about 70 years old. So he's looking to sell in the next year or two, but it's about for him, who's going to take over his business. For a lot of these individuals that are at retirement age, look, there's the true motivated seller, pancreatic cancer, you know, heart disease, divorce, a distressed seller, not a distressed business, a distressed seller. The psychology of the seller is like, fuck, I need to sell. Okay, this guy doesn't categorize. The other kind of motivated seller is just, yeah, it's that time. It's the, yeah, I should be, you know, I want to move my family to Florida now. They don't need it, but they want it. And so for that type of an individual, they're able to ask a lot more questions of the buyer to say, hey, what's your strategy if you were to buy my business? Hey, what gives you the credibility and the expertise to know you can keep operations going as they have been smoothly? This business we're looking at, that's about a $4 or $5 million acquisition. It's a really smoothly run business. He's trying to think to himself, hey, how can I be sure that if you buy this business from me, that it's going to continue to operate the way it has been, right? So that's the process we're in right now with that one off-market deal that we found from cold calling. There's others that we're exploring right now, but that's the one that's the hottest. If everything went delightfully, we would close that in about 60 days, but that's to be determined. We'll see. So yeah, at this stage, we have everything ready. We're just being really patient as we take action on our first deal. I'll actually share that there was a $4.6 million portfolio that we looked at buying. I passed on it somewhat to the chagrin of some of my board members. Some of the board members wanted to go forth with it. Others did not. I didn't feel it was the right deal. I felt there were too many red flags. I felt that it would put the company to position where we would be rolling the dice on whether or not we'd be successful long-term. And for me, my ultimate goal is to build a $1 billion business. I want to build $1 billion a year in revenue business. But for me to get to that stake or to that place, I need a strong stake in the ground. I need a strong foundation. And so we're being really selective with our initial acquisitions because the first and second acquisitions, everything. We don't have fallback revenue. It's like that guy, the Portuguese or the Brazilian individual that has the $4 million business we talked about a minute ago. He has a fallback. If he made a poor acquisition, he still has revenue to cover debt service and to make sure he's A-okay. We will get to that point where we're at that stage, and then you can be more aggressive. The growth trajectory that we have, or the trajectory is like this. It's slow, 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 and then it fucking skyrockets, right? You got to be safer, a little more risk, a little more risk. All right, let's fucking crank up the heat. We've got a lot of cash flow. And it's not literally like that, but that's something of the philosophy that we're following as we go forward. So hopefully that answers your question there. All right, let's wrap. One or two more questions. One last question. I know it takes cold calling for deal flow, but how do you know who to call? That depends on your strategy, Latif. Again, I'm sorry to bust your balls, man, but like I can't tell you how to run your business. But the answer is you're going to only want to call businesses that follow your strategy, your acquisition strategy. That would be the answer. Okay, I'm thinking of going after digital marketing companies rather than one-man SEO, PPC. Yeah, exactly. You want to go after bigger companies that are not just some goofball in his underwear. That's a tough company in my estimation to acquire, because when you do, unless if you're going to get him to stay on board to do his PPC, then what's going to grow of it, right? You're going to have to jump in and you're going to be an employee, not an employer. You're going to be working in the business, not on the business. So unless if you can buy a one-man digital marketing shop and maybe give him 40% of the cut and you keep the 60 and you give him kind of the resources, but you would have to structure something like that where he stays working in the business so that you can work on the business. Okay. How soon would you expect to start earning on the first acquisitions? Scott, and this is going to be my last question. I'm the guy that eats last. I'm not doing this to get rich short term. Okay, our salespeople on our sales team, if they bring me deals, they get paid before I do. The bank, they get paid before I do. If we have investors that we use, and in, say, an 80-20 split, 80% leveraged with debt, 20% with investors, for example, those individuals get paid. I'm trying to grow $1 billion business. So for me in the short term, it's not about getting rich. When would I get paid? After everyone else gets paid. I want to get everyone else get paid, because when everybody else gets paid, now they get hungry to do fucking deals. You get into this carnivorous animal that wants to do another deal and another deal and another deal. And I'm about building valuation and equity, not about short-term paychecks, right? Valuation in businesses and equity in that business, right? I want to grow a big fucking company. So if I don't get paid right away, fine. I'm not even trying necessarily to get paid right away. I'm looking, once we find a kick-ass deal, I'm going to give a lot of it away. Salesperson, take it. Board, take it. The bank, take it. Investors, take it. All I want is the credibility of Jason Rogers put together a $5 million deal and it went smoother than baby's ass. You know what I'm saying? That's what I care about. Because from that point, then yeah, trust me, it's going to be easy for me to make my money. And for the record, if it's a $5 million deal, my net worth is 3 or so million, right? Because I have about 60%, 65, 70% of the company. So in sheer stock, other than, of course, you have to pay off that debt. So it's not really all yours, but given you don't default on the loan, I'm pretty much building myself up to owning a $3 million of the $5 million asset. I have, staked to about 3 million of it. So that's for me. I'm the guy that eats last, but ultimately I'm building valuation. So that's the answer. Look, I don't see any other questions. I really appreciate you guys being here. Do you know what we got? One man. Dan says you should always, Bob Saget, Dan says you should always pay yourself salary. Of course he does. But on the first deal, look up Dan Pena for that. Let's talk about that real quick. I get fired up. Look up Dan Pena's stuff where the first year he went in business, he did $50 million and he put together a $30 million deal and a $20 million deal with the US government in oil. And how much did Dan make? The answer, 90 grand. Okay, $50 million deal, he made 90 grand. So yeah, Dan says pay yourself first, but when you don't have a track record, you don't pay yourself first, okay? Business is nuanced. Of course, down the road, I'm gonna pay myself like a fucking king, and everyone's gonna get paid like a fucking king. But when you don't have leverage and track record is leverage, then you pay everyone else first so that you can do more deals. And then you pay yourself. So I get what you're saying, but there's nuance behind that point. So that's worth noting. Okay, does your board get paid bonus off the refinance? It depends on the deal. And how do you pay yourself? And then the board after the acquisitions, I just talked about that. I pay the board and the salespeople and the bank and the investor before me on the first deal. That's how I'm doing it. You don't have to do it my way. I have a sales team. You don't need a sales team. Right? You don't need to give your board money. You don't have to. They're only entitled to the stake in the business. I'm going to do these things because I want to create a hungry animal. All right. I'm thinking long term. So that's the way I'm rolling. To each his own. Guys, I'm out. I'll talk to you guys soon. Thanks for everything. If you have more questions, drop in the comments. I'll try to get to them, and stay handsome. Peace.